What is happening, crypto crew? Get ready for a rapid-fire update that's going to blow your mind. The market is moving faster than ever, and if you're not plugged in, you're missing out on the biggest plays. We've got game-changing predictions, market shifts, and insights that could redefine your strategy. Buckle up, because this is the Bitcoin Bulletin, and you're about to get the unmissable intel you need to stay ahead of the curve. Let's dive in. First up, we're heading to Bitcoin Asia 2025, where the biggest names in mining converged, and a jaw-dropping prediction about Bitcoin's future value sent shockwaves through the industry. This wasn't just a conference. It was a declaration of intent from the power players shaping the network's very foundation. Prepare for a deep dive into the future of hash power and a valuation that could change everything. Then, we're hearing from a Wall Street veteran who's issuing a stark warning about Bitcoin's potential short-term volatility, even as he reaffirms his belief in its monumental long-term growth. What does this mean for your portfolio? We break down the sentiment and the strategy you need to navigate these choppy waters. Next, we're looking at the surprising connection between gold's recent surge and what it could signal for Bitcoin. A key indicator in the bond market is showing strength, and it might just be the catalyst that boosts both traditional assets and digital gold. We're exploring the correlation you can't afford to ignore. And finally, we're dissecting Bitcoin's recent performance, examining why August was a tough month and what the charts are saying about the road ahead. Was it just a seasonal blip, or are there deeper trends at play? We've got the analysis that cuts through the noise. Don't miss a single second. Hit that subscribe button, ring the notification bell, and let's get into it. The $1,000,000 Whisper, inside Bitcoin Asia's bold prediction. This event wasn't just another crypto conference. It was a powerful convergence of the architects of Bitcoin's infrastructure, the miners. Bitcoin Asia 2025, hosted in the vibrant hub of Hong Kong, transformed into a crucial gathering for Asia's hash power communities, the very entities that form the unshakable backbone of the Bitcoin network. The convention floor buzzed not only with the usual array of fund managers and representatives from major exchanges, but also with the presence of farm operators hailing from diverse regions including China, Kazakhstan, Southeast Asia, and North America. These are the individuals whose relentless commitment to acquiring cutting-edge hardware, securing favorable energy contracts, and navigating significant risks is what truly keeps the Bitcoin network alive and thriving. The most electrifying moment of the entire summit arrived on August 29th, when Eric Trump took to the stage. With his signature directness, he declared, "There's no question Bitcoin hits $1 million." These words, concise yet profoundly impactful, resonated deeply within the audience, igniting a palpable sense of validation among current holders and, perhaps more importantly, offering essential reassurance to the miners. For those investing heavily in the massive commitments required for hardware, energy, and infrastructure, such a high valuation is not merely desirable. It's fundamental to the viability of their operations. It underscores the purpose behind their substantial investments. Satoshi Nakamoto's foundational design, meticulously laid out in the 2008 white paper Bitcoin, a peer-to-peer electronic cash system, has long established the strict boundaries of Bitcoin's supply. The total issuance is permanently capped at 21 million coins. By August of 2025, a significant milestone will be reached. Approximately 20 million Bitcoin will have been mined, leaving fewer than 1 million coins yet to be released into circulation. This controlled scarcity is reinforced by the halving mechanism, where the block reward is cut in half every 210,000 blocks, occurring roughly every 4 years, thereby progressively slowing the rate of new Bitcoin issuance. The final Bitcoin is anticipated to be mined around the year 2140, embedding this inherent scarcity into the very fabric of the network's structure. At its current price point, hovering around $108,000, Bitcoin boasts a market capitalization of approximately $2.1 trillion. This valuation already positions it as a significant player, representing about 1/7 of the total value of global gold. Should Bitcoin achieve the ambitious $1 million per coin mark, its total value would skyrocket to over $21 trillion. Such a leap would not only surpass the market capitalization of gold, but also begin to challenge the established dominance of equities and bonds as the primary pillars of global capital allocation. The author posits that if Bitcoin were to reach $1 million per coin, its circulation might significantly decrease, shifting its primary role from a medium of exchange to an ultimate store of value, potentially eclipsing gold itself in perceived value. However, the journey toward such a monumental valuation is fraught with considerable challenges. Bitcoin's continued ascent hinges not only on unwavering investor confidence, but also on its capacity to surmount several formidable constraints. Regulatory uncertainty remains the most significant hurdle. The actions of the U.S. Securities and Exchange Commission, SEC, the European Union's markets in crypto assets, MiCA framework, and existing prohibitions in China all contribute to an environment of uncertainty surrounding exchange operations and cross-border capital flows, directly impacting market confidence. Furthermore, market depth presents another challenge. With daily trading volumes typically ranging between $30–50 billion and relatively low adoption for payment purposes, sustaining a $21 trillion valuation is far from a straightforward endeavor. Energy and environmental concerns also loom large, as Bitcoin mining's substantial electricity consumption draws considerable ESG scrutiny and places upward pressure on operational costs, potentially capping hash rate expansion. Intensifying competition from other digital assets, such as Ethereum, also diverts capital, with Bitcoin's market dominance fluctuating around 50–60%. Beyond economic factors, technological uncertainties persist, including the limited adoption of the Lightning Network and the long-term threat posed by quantum computing. Ultimately, these diverse challenges converge on a critical axis: regulatory uncertainty. This factor influences liquidity, adoption rates, and institutional participation more profoundly than any other, and it may very well be the decisive element in determining whether Bitcoin's aspirational million-dollar dream is ultimately realized. But what if the future isn't just about price predictions? What if it's about navigating market turbulence with expert advice? Stay tuned as we hear from a major investor about potential Bitcoin drops. Navigating the storm. Scaramucci's $500 K Bitcoin forecast with a 40% caveat. Anthony Scaramucci, the dynamic founder of Skybridge Capital, has offered a candid projection for Bitcoin's trajectory, forecasting a potentially volatile path ahead before it reaches his ambitious target of $500,000. In a recent conversation with Coinage, the seasoned investor issued a notable warning. The flagship cryptocurrency could experience a significant downturn, potentially shedding up to 40% of its value. Despite this cautionary note regarding short-term fluctuations, Scaramucci remains steadfast in his conviction regarding Bitcoin's immense long-term potential and its transformative role in the global financial landscape. Scaramucci articulated a compelling perspective on volatility, asserting that it's not an anomaly, but rather an intrinsic characteristic of the Bitcoin journey. He stressed the critical importance for investors to cultivate the psychological resilience necessary to weather downturns without losing sight of the broader, long-term vision. This mindset, he suggests, is crucial for capitalizing on the eventual growth. Furthermore, he highlighted that the practical application and integration of Bitcoin into the wider financial system are still in their nascent stages. A common pitfall for many investors, he observed, is the tendency to underestimate Bitcoin's future significance and its capacity to reshape financial paradigms. Consequently, while short-term price corrections might induce nervousness among traders, Scaramucci views these movements as a natural and necessary component of any robust growth cycle. He draws parallels to his own early career missteps in traditional markets, recalling instances where he prematurely sold stakes in tech giants like Apple, Amazon, Microsoft, and Nvidia, thereby missing out on astronomical gains. His core advice to investors, therefore, is elegantly simple yet profoundly impactful. Maintain a firm grip on quality assets and resist the alluring temptation to divest during periods of market turbulence. This philosophy of holding firm through volatility is a lesson learned from his own experiences, emphasizing the value of patience and strategic foresight. Scaramucci's reflections extend beyond the realm of digital assets, serving as a broader commentary on investment strategy. He recounted how his early dismissals of promising companies in their infancy ultimately cost him substantial returns, reinforcing the paramount importance of long-term perspective and the ability to recognize and hold onto future value. He powerfully argued that this same principle holds true for Bitcoin today. In his expert opinion, maintaining a holding period of 5 to 6 years for digital assets like Bitcoin could yield returns comparable to those enjoyed by the earliest backers of the world's leading technology firms. This long-term outlook is key to unlocking Bitcoin's full potential. Moreover, he cautioned investors to be aware of the frequent disconnect between market perception and underlying reality. Periods of apparent stability and prosperity are rarely permanent, and unforeseen challenges can emerge precisely when conditions seem most favorable. However, for those who cultivate discipline and maintain a strategic focus, market corrections present invaluable opportunities to consolidate their positions and reaffirm their commitment, rather than succumbing to fear and retreating. As the broader cryptocurrency market currently exhibits a bullish sentiment, Scaramucci's caution serves as a vital counterbalance. He reiterated his forecast that Bitcoin might indeed experience a significant dip before ascending to his ambitious target of $500,000. His overarching counsel remains grounded in unwavering belief. Investors who have faith in Bitcoin's fundamental value should remain resolute and embrace volatility as an integral part of the maturation process. While seasoned investors offer their strategic outlooks, the markets themselves are revealing fascinating trends. Could traditional assets hold clues for digital ones? Let's explore the surprising link between gold's recent rally and Bitcoin's potential upside. Gold's golden touch, a yield curve steepener that could boost Bitcoin too. Gold has recently experienced a significant upswing, reaching its highest price point since April, and the prospects for further gains appear robust, largely driven by a phenomenon in the bond market that is often overlooked: the steepening of the Treasury yield curve. This dynamic shift in fixed income markets could very well translate into a favorable tailwind for Bitcoin as well. Over the past 10 days alone, the price of gold has surged by more than 5%, pushing past the $3,480 per ounce mark and drawing tantalizingly close to its previous record high of $3,499, which was set back on April 22nd, according to data from TradingView. This impressive rally is unfolding concurrently with a noticeable steepening of the U.S. Treasury yield curve. Specifically, the spread between the yields on 10-year and 2-year Treasury notes has widened to 61 basis points, marking the most significant gap seen since January 2022. Similarly, the difference between the yields on 30-year and 2-year Treasury notes has expanded to 1.3%, the broadest margin observed since November 2021. This widening of the yield curve, often referred to as a bull steepening in bond market parlance, is primarily attributed to a more rapid decline in the yield of shorter-term bonds. The 2-year yield, for instance, fell by 33 basis points in August to settle at 3.62%. In contrast, the 10-year yield saw a more modest decline of 14 basis points, bringing it to 4.23%. In the intricate world of bonds, this scenario signifies that shorter-term debt instruments are experiencing a more pronounced price increase, and thus a yield decrease, relative to their longer-term counterparts. Ole Hansen, the esteemed head of commodity strategy at Saxo Bank, provided a clear explanation of why this particular market dynamic is inherently positive for gold. For gold, lower front-end yields ease the opportunity cost of holding non-yielding assets, Hansen stated in a Thursday analysis note. He elaborated that this shift is particularly beneficial for real asset managers, many of whom have faced difficulties, or in some cases outright restrictions, in allocating capital to gold while U.S. funding costs remained elevated. Hansen pointed out that total holdings in bullion-backed exchange-traded funds, ETFs, saw a substantial decline of 800 tons between 2022 and 2024, a period coinciding with the Federal Reserve's aggressive interest rate hikes aimed at combating inflation, which consequently drove up short-duration yields. Bitcoin, often drawing comparisons to gold due to its role as a store of value, shares a similar characteristic. It is also a non-yielding asset. Neither Bitcoin nor gold generates interest or dividends. Their value is predominantly influenced by factors such as scarcity, market demand, and overall investor sentiment. Therefore, the observed decline in the 2-year Treasury yield can be interpreted as a bullish signal for Bitcoin. Meanwhile, the relative resilience noted in longer duration yields can be attributed to persistent expectations of sticky inflation and other macroeconomic factors. These same factors also tend to bolster the bullish case for both gold and Bitcoin. Analysts at ING noted in a client advisory on Friday, the U.S. Treasury curve has unsurprisingly steepened. Lower rates today risk inflaming inflation further ahead, which is bad news for bonds. Hansen further explained that the sustained strength in the 10-year yield is largely underpinned by inflation breakevens, which are currently hovering around 2.45%, with the remainder of the yield representing the real yield. It signals that investors are demanding greater compensation for fiscal risks and potential political interference with monetary policy. This environment typically supports gold as both an inflation hedge and a safeguard against policy credibility concerns, Hansen elaborated. The nominal yield on a bond is composed of two key elements: the inflation breakeven rate, which reflects the market's anticipation of average inflation over the bond's lifespan, and the real yield, which represents the additional return investors demand above and beyond inflation compensation. Historically, gold and gold mining stocks have demonstrated some of the strongest performance during prolonged periods of yield curve bull steepening, according to historical analysis by Advisor Perspectives. Conversely, equity markets tend to underperform in such economic environments. This positions Bitcoin in a particularly interesting spot, given its dual nature. It functions as an emerging technology asset that often exhibits correlation with tech stocks like those on the Nasdaq, while simultaneously possessing characteristics akin to gold as a perceived store of value. This complex interplay of factors suggests that the current bond market dynamics could indeed offer a supportive environment for Bitcoin's price action. While the macroeconomic landscape offers intriguing signals, the digital asset space itself has seen its own share of market drama. What happened in August, and what does it mean for September? We've got the breakdown. August burn, Bitcoin's summer rally erased. What's next for September? In the often unpredictable world of financial markets, discussions surrounding seasonal indicators can sometimes feel a bit worn out. The classic adage, sell in May and go away, gets trotted out every spring, yet its historical validity, particularly since the days of Jesse Livermore when traders literally took extended summer breaks, is highly debatable. Even within the relatively young cryptocurrency markets, which lack the extensive historical data needed for statistically significant seasonal analysis, certain patterns have emerged. One such recurring theme is that August has historically been a challenging month for asset prices. While the proponents of seasonality might be accused of clinging to folklore, they certainly got the prediction right this time, at least for Bitcoin. Despite a continuation of inflows into spot Bitcoin ETFs, a dovish pivot from Federal Reserve Chairman Jerome Powell, and the cryptocurrency even touching a new record high, Bitcoin has experienced a notable decline of approximately 8% throughout August, with only a few hours remaining in the month. Currently trading just above $108,000, Bitcoin is also down roughly 13% from its peak of over $124,000 reached on August 13th. This significant sell-off has effectively nullified Bitcoin's entire summer rally, pushing its price modestly below its Memorial Day level of $109,500. This underperformance in August stands in stark contrast to that of Ethereum ETH. While Bitcoin faltered, Ether managed to post an impressive 14% gain in August, thereby outperforming BTC by a substantial margin of 2,200 basis points. Ether's relative strength can be largely attributed to the significant capital inflows it attracted through ETH treasury companies and, more notably, the launch of spot ETH ETFs. These Ethereum ETFs, introduced just a few months after their Bitcoin counterparts, initially saw much more modest inflows. However, this trend has dramatically reversed recently. Data from Bloomberg's James Seyffart reveals that through August 28, the ETH ETFs attracted a staggering $4 billion in inflows, dwarfed only by the $629 million seen by BTC ETFs. When considering the relative market capitalizations, Ether's $500 billion is less than a quarter of Bitcoin's $2.1 trillion. These inflow numbers for ETH become even more remarkable. This suggests a significant shift in capital allocation within the crypto space during August. The broader economic environment likely plays a role in this dynamic. In a landscape where the U.S. Federal Reserve is maintaining a moderately restrictive monetary policy, and fiscal policy is tightening due to factors like increased tariffs, essentially higher taxes, available capital becomes more constrained. For the cryptocurrency market in August, it appears that this limited capital was predominantly directed towards Ethereum, seemingly at Bitcoin's expense. Looking ahead, the seasonal indicators for September also paint a potentially challenging picture for Bitcoin. Historically, September has often been an even more difficult month than August. Analysis from Glassnode indicates that in the 12 Septembers dating back to 2013, Bitcoin has seen price declines in 8 of those months. The 4 instances where BTC managed to advance during September, the gains were relatively modest. Consequently, the average performance for Bitcoin in September over the last 12 years has been a negative 3.8%. However, it's crucial to temper these seasonal observations with a dose of perspective. 12 years of data, while informative, is still a relatively small sample size for establishing definitive statistical validity, especially in a market as rapidly evolving as cryptocurrency. Furthermore, a significant portion of these observations, specifically from 2013 to 2019, occurred when Bitcoin was still considered a fringe asset, largely off the radar for mainstream investors. Therefore, while historical patterns can offer context, they should not be the sole basis for investment decisions. From macroeconomic influences to seasonal trends, the forces shaping Bitcoin's price are complex. But what if the key to understanding Bitcoin's future lies in looking at traditional stores of value? We'll explore that next. All right, crypto fam, let's do a lightning recap. Bitcoin Asia saw a bold $1 million prediction amidst minor gatherings. Anthony Scaramucci warned of a potential 40% drop, but remains bullish long-term. Gold's rally might be signaling good news for Bitcoin thanks to yield curve dynamics, and August proved tough for Bitcoin, wiping out summer gains while Ether surged. Stay informed, stay invested. If you found this update valuable, smash that like button, subscribe for more, hit the notification bell so you never miss a beat, follow us on all social platforms, and drop a comment below with your biggest takeaway. We'll see you in the next one.